Hello everyone. Before I start introducing Mr. Anil Rego, I would like to thank each and everyone for taking the precious time and joining this webinar. And also the last 15 minutes will be a Q&A and the participant can write their queries in the chat box. So Mr. Anil Rego is an investment professional, entrepreneur and a writer. He joined the finance department of Wipro Technologies after completing his postgraduate degree in finance and worked in the field of business planning and mergers and acquisition. He is the founder and the CEO of the Right Horizon Financial Services. It's been 18 years. So with the aim of assisting people in achieving their financial goals, a mission that is dear to his heart and one that he has accomplished at a very young age. Right Horizons today boasts of a strong portfolio management scheme team that manages close to 350 crores and has been among the top performers over the last several quarters. The assets under management are approximately 1,200 crore with wings spread across Bangalore and other major cities. Mr. Anil is a well-known and a respected figure in personal finance industry, and he's often quoted and he writes articles for leading print publications. He is also regularly invited as an expert by leading business channels like ET Now and CNBC TV 18. Now I request Anil sir to go ahead. Thank you.
So good morning and welcome to this webinar. Thank you, Nidisha, for the pretty long introduction, I must say. Okay, we have markets taking a break after a period of time. Also, I think in our minds, again, COVID is back in. It was out of our conversations for a period of time, but now it is back. In this sort of backdrop, I think one would like to share my points of view, and especially on the mid and small cap, stocks, and that's another question, in our minds. So let me start off with my own journey as to how I got into investing into stocks. Somehow. Investments was passion for me. So for my second PUC days or the 12th standard, I actually started investing in stocks. Some of the savings of my mother, she lent it to me, and I put it into the stock market. And absolutely had zero background, but somehow there was that interest. I walked across to a broker's office from Frasertown to all the way to JC Road, and started off my investment journey. At that time, my whole focus was around saying that can I actually invest in stocks that become multi-baggers? Okay, so multi-baggers was about where it goes more than 100%, which means if you invest in a stock at say 100 rupees, if it goes to 200 rupees or more, then it's called as a multi-bagger. So I focused on stocks which are less than 100 rupees. And many of them, let's say 36 rupees became 150, and things like that, doubling, tripling, in value. So that was the focus. So in some form, when I do this presentation on mid and small caps, it sort of reminds me of my early investing days. Okay, and I hope that some of you will also end up doing this and making good money for yourself and also probably helping you achieve your own goals. So I began about saying that we all may have many questions. Has the market peaked? The COVID again, will we see a massive second COVID? And we already saw the impacts last time. So are we likely to see a large fall again like last year? Haven't mid caps and small caps run up too much? In fact, some have very fundamental questions saying why has the market run up in the first place? Okay? Because we are not seeing growth on the ground, especially if you go and talk to some of the small business guys, they say, okay, for me, actually, things have not improved substantially. So why is market going up? So when we have some of these questions, I would like to say, one is you focus on all these questions, or you focus on what do we know, right? And so starting off with the fundamental principles, that the stock market has actually outperformed every single asset class over the last 30 years. And this is a graph. So if you had invested 100 rupees in say 1990, right? This is what it would be in 2020. Okay, it would be almost like 5,068 rupees. Okay, so that's the big move that has happened versus some of the others. The PPF, for example, has gone up to 1,565, and gold has done a little better than that. So the point is, equity does and is the best performing asset class both in India over long cycles. Even if you look at globally, I think equity has always been the best performing class. But the question that many of us sort of experience is, does it reflect in our own wealth? I mean, for many of us, we wonder, actually, sometimes FDs have been the best performing, right? So what is it that, why is it this way? So we need to keep in mind that markets tempt you to do the opposite of what you should be doing. So, after, you heard somebody else has made some good returns, one enters, and probably that's a bad time to invest because market has already run up. And possibly, once it falls, you say, okay, enough is enough and get out of it. And, or when the time is right, when the market has fallen, you don't have the guts to come and invest at that point of time. So basically, to start off, before I get on, with little more on the theme itself, just the investment basics, and just to reinforce that. Okay, our view has always been that patient, disciplined, process-based investing is actually the best way to make money, because in that example that you saw, 5,000 rupees, 100 rupees has become 5,000 rupees from 1990 to date. Similarly, if you see the Sensex in itself, if it has hit 50,000, it basically means that from 1979, an index always starts at 100. So from 1979, the index has gone up 500 times. Okay, so markets are and deliver good returns in the long run. But the question is, if you are just patient and disciplined in terms of your investing, you'll probably participate in that rather than being a little ad hoc and getting tempted and coming in and going out at possibly the wrong times of the market. So the second is about thinking long term. Everybody thinks that equities is a place where you make money quick and you get rich quick. Actually, if you actually go back and see, you can make it quick, but you can also lose it quick, and that's what normally happens. But in the long run, if the probability significantly increases of you making a very good return. So if you think long term, that's a good way to look at it. And the third part is for somebody who wants to invest in stocks. Okay, you need to start looking at businesses, and predicting the future of single business is easier than sometimes predicting the future of index. So you would see that for your stock, if you are sort of tracking the underlying business itself, the returns will follow there. Okay, of course, predicting the index also is something that can happen, but it will probably sort of come in with experience. So coming to our topic of mid and small caps, okay, and the outperformance, okay, this has been the rolling return, of if you look at a 1 year return for the last 15 years, okay, that's what the rolling return is. Just the example is if you look at 2000 to 2001, 2001 to 2002, like that. So every year you look at 1 year periods and you average that out. Okay. Interestingly, there is not too much of difference between the mid caps and the large caps, because the Sensex has delivered say 14% and the mid cap index has delivered say 14.68. Okay, so there's nothing much to sort of differentiate between them. Okay, and this is something that we keep in mind, and we'll also probably try and analyze why. Okay, because typically we think that maybe mid and small caps will do much better. But again, if I look at it here as well, you will find that when you look at longer term periods, say 10 years, 15 years, etc., you will find that it's almost starts equalizing even right from the 5 year period onwards. So this is something that we should keep in mind, that between the two, probably both of them deliver similar in the longer run. Okay, so I have a poll for you. Okay, let's look at a volatile year that 2020 was, with COVID and all of that. Did mid caps do better or did large caps do better? Okay, I will request my team to sort of trigger the poll. Yeah, what do you think did better in a very crazy and volatile year, right? Okay, there's a good speed in polling. Please continue to do so. Right now, we are 63% saying mid caps did better and large caps, 37% of the people are saying did better. Yeah. Yeah, so if anybody who's not polled can, add to the polling. Okay, we have about 15 seconds left, okay, for the polling. It's about a minute, okay. And okay, thank you. So good participation from all of you, and 63% of the people said mid caps did better than large caps, and I think that shows that we are very well informed, and congratulations. Okay, so that's thank you. Okay. So this is what happened over the last few years, and yes, 2020 is the yellow bar. Okay, you'll see that the Sensex, BSE Sensex went up 15%, then S&P BSE Midcap Index went up 20%. So, and it is really surprising because one would have thought in an extremely volatile year that COVID was, you would find that mid-caps should have fallen more than large caps. And this actually brings me back to my point that there's a cyclical movement between mid caps and large caps. Okay, and so if you look at it here, in if you look at the blue bar, right, which is 2017, large cap index did better. The mid cap index did better. The large Sensex did 28%, which is the large cap index, and the BSE mid cap index did 48%. In fact, the small cap index did even better at 60%, okay, in a single year. The 2018 was a different scenario where the large caps did better because large caps went up 6% and mid caps actually fell 14% while small caps fell 24%. Okay, the subsequent year, 2019, again the same scenario where large caps did better. Large caps went up 15% while mid cap index fell 3%. And the small cap index actually fell 7%. So at least if you see here, there were 2 years that the previous 2 years, 2 to 2020, large caps did better than mid caps, and the previous year, which is 2017, mid caps did better. So our view is that you find both of them move in cycles, and so while we looked at the mid caps and large caps doing similar over a longer period of time, if we are able to get the performances of mid caps versus large caps right, we can see from this chart that it can be our returns can be substantially better than the index. Okay, so even if we get it broadly right, it will do well. So what does this teach us is that if mid caps are doing very well or large caps are doing very well, we need to start looking out for turning points when possibly the other thing starts moving the other side, either a mid cap or large caps and vice versa. Okay, so that is one sort of learning and takeaway that we have from this, that while in the longer run, both large cap and mid cap indices deliver similar returns, in cycles, they do better. So if we are able to get those cycles, we will deliver much larger returns. So if I come from 2020, from March 2020, this financial year itself, you will find that the small cap and the mid cap indices continue to deliver better. So not only last year, this year also for the last financial this year from 2020 to March 20, Feb 21, mid caps have done better. Yeah. Now, coming back to my point of saying there is divergence, if we want to look at say what is the period of divergence. This chart is a very simple one actually. What it does is it looks at how much is the Sensex returns, how much is the mid-cap returns, and what's the difference between the two. We just in a simple graph capture the difference between the Sensex returns and the BSE mid-cap returns. Okay, so what is interesting is if you see in the peak of April 2016 or so, okay, the Sensex delivered almost like 20% higher than the mid-cap index. Okay, and vice versa, happened. So if you see in periods, there were months where there was underperformance almost like 10%. So there is a movement between the two. And if you look at the cycle on average is anywhere between say 2 to 3 years. Okay, so it's not a short-term move either. So if you see the October 2013 to about 16, which is 3 years. Similarly, that it moved from 16 to 19 or even 20. So that's almost like 4 years. Okay, so that is the type of movement that happens. So my point to you is it's not such a shorter term move, which is why our view is that we'll probably see the mid caps do better for a slightly longer period of time. Okay, so this was a trigger that we gave to our clients that we think that the index will start moving towards mid caps. And interestingly, in a year like COVID, okay, it actually played out for our clients, and we started slowly moving into mid caps, and that they were able to participate in the move up. Now, keep in mind that while things are good, right, in mid caps, I just wanted to remind you that when the mid caps started falling, right, from 2017 onwards, you will find that the fall was very, very large. Okay, so which from an outperformance of almost like 20%, they underperformed by 10%. Okay, so and over multiple years. Okay, so that was a huge difference, and in that period, it was not unusual to see some of your mid-cap stocks down anywhere between 40 to 60%, which means if you invested 100 rupees, it may have gone down to 40 rupees. Okay, so that was a large fall that happened, and we must keep in mind that while mid-caps fall, they can fall very, very sharply. While they go up, they also go well. So one needs to keep watching between the two if you have to be successful in markets. So the second part of it is where the last month Super Value, which is our mid-cap fund, did very well, and I thought let me capture what are our learnings, okay, from that, and what is it that maybe some of you can take home into your own investing careers, into if you like to invest in stocks, okay, what is it that you can take home and improve for yourself. I think the first is, again, a fundamental principle, we follow a very disciplined investing process. Okay. And I think that does two things. One is it helps deliver better returns. And more importantly, it sort of helps deliver consistent returns, because we don't want to be, seeing our portfolios run up and down like the stock, the index, right? So, and suddenly you see very huge money, where you see losses. While you may see a good return, it may just keep you, very, tensed in terms of your returns, when you look at your investing process. So what is it that we do? For example, we have broken up, each of our investing stages, and we have a process for each of them. For example, the screening process is a very structured one, which means from the whole universe of stocks, where you have, thousands of stocks, it's impossible for you to invest in all of them. So you need to come down to a smaller list. So which is what we do in the screening mechanism, but we do it in a scientific way. We look at various parameters like return on equity, ROE, return on capital employed, ROCE, the profit after tax, the revenue growth, promoter holding. We have various parameters and we screen it. Some of them are parameters which we exclude companies. Okay. So for example, if the debt equity is too high, we just exclude them. Okay. So some of them are then, we come down to a smaller list of maybe anywhere between 150 to 200 companies, which we are sort of able to look at and manage. And then we do a ranking of those companies, okay, which either we hold or we track within our screen, okay, and then that helps us come to a framework which is not too qualitative, okay, and helps, and we found that once we did this ranking, returns have become a lot more consistent, and we have continued to keep on, fine-tuning it and improving it. The other part of it is the risk management side, which I think is a very important one, okay, because if, for example, you look at a company and there's a corporate governance issue, you're likely to see a large fall, which can really damage your portfolio returns. Okay, and that's how it's very, very important to look at this. The second part of it is active risk, because there are periods when let's say the debt equity ratio becomes very important for markets. So there are periods it's important to keep tracking of how is the environment, and sometimes it will be conservative. So risk management again can also come down to saying that, okay, if something is done very well, if valuations are very high also, does it make sense to sort of rebalance the portfolio? Okay, from a risk standpoint, if some stock has really done a very extremely well, there's something that we need to do. The other part of it is about, the RH pendulum. The RH pendulum is more for us to help time the buys and sells. Okay, so we have levels of buys and sells that we put in, okay, and we do that in advance, so that, we are not swayed at that point of time and carried away, into doing, getting carried away with the market. And because I said, you need to be able to stay away from the market and get carried away, so that you are able to identify the turning points, and they are very, very important for you to see, good returns. The second part of it is, I believe that having a good solid team to back one up. Okay, while I'm the CEO and fund manager, okay, I have two very good team members who are assistant fund managers, both Prabhat and Vijay. Okay, and in fact, the Super Value is a fund which they basically manage more actively, and I just tie in the loose ends. So that's something which is an important thing. And why is teamwork and collaboration important while investing? It's because we think in a certain way, right? So bringing in complementary thoughts become important, and so we have a team which works cohesive way, and each person has their own strengths. So I have the experience of market movements over long periods of time, and so the rejigs between, say, mid caps, large caps, getting conservative, getting aggressive, etc. Those are things that I bring in based on my experience and the team with very deep, in-depth process-based research, etc. Goes and finds out, and so that's something that we like to do, and get a combination of the small picture and the big picture through teams. Okay, the other part of it is about, now you may come back and say, as investors, okay, what should I be doing, right? I'm on my own, so I don't have a team. Okay, so what I would think, and I'll again go back to my own investing days, okay, is one is you can collaborate with investors. Of course, in my days, I didn't have too much of collaboration, because at least in Bangalore, you didn't have as many people investing in stocks, but I at least had one friend who, I used to work with. We used to both, for a period of time, we used to go to the broker's office and, trade for some time. And that's something that I would suggest each of us can also do, get into collaboration with other investors and share thoughts, okay, and so that different views can come up. And at points, you need some of the red flags to come up to you when, you think markets are going to turn, etc. The second is, I think, which I've also used very effectively. In fact, right from, my investing days, I used to subscribe to certain newsletters of experts. Okay, and one example is, there are, technical analysts of, who are among the best in the country, and subscribing to some of them, because they have done subscription services, you can just subscribe to some of them, and some of the more complex technical analysis which we want to leverage on, one can end up taking advantage of it. And obviously the last is about, okay, if I'm just saying, if investing in stocks not necessarily comes as something good to all of us. Okay, some of us have interest, some of us don't have interest. So if you don't have interest, or you've seen that the mindset is not there for investing, especially sometimes we get carried away at market highs, or when market lows, then you should actually use a professional fund manager. The third is about identifying undiscovered names, and what is, I think, the most important factor for returns in mid caps, and why did our fund do very well last month, is because we ended up buying into names which subsequently markets started loving and following. Okay, so and that's a very, very important part of investing in mid caps. And so I said, what is different? So if some of us are investing in the broader market, I think many of us love to invest in the blue chips, and we've seen very good returns with them in the long run. Okay, so how is investing in mid caps different? And if I want to look at it, what should I do differently? Okay, so I think the first part is availability of information is low. Okay, relatively, because in a large cap name, actually I can get a lot of analyst reports, etc., which are available for me to cross-refer. You can see there's a lot of information there, and since there's a lot of information, with public information and and information which is at a very higher level, say looking at PE ratios and a few basic things, I may be able to invest and do well. Okay, but in mid caps, I think that's not the case. You actually need to go down and start understanding individual companies. The first thing that you need to do is understand the corporate governance of the company. Okay, so and if it's a group which is of poor corporate governance, okay, then you should just ignore it. Okay, and that will also be obvious. I mean, you may come back and say, how do I identify them? One is, if you're part of many of these chat groups and stuff like that, you can sort of identify. The second is, many times it's also reflected in the PE ratio, because the wider set of people, tend to know it directly or indirectly. So you'll find that, many institutions also may not come and invest into some of those. But of course, when you're looking at mid and small caps, you're not necessarily, look for companies which are already discovered, right? So there may not be as much there, but where a combination of factors you try and understand on corporate governance. It could include, looking who's their auditor, right? If it's a really shoddy looking auditor, then you need to be a little careful and wary. There are other ways to look at corporate governance and through financials, okay, which maybe my team has also sort of tried to highlight in the past there. So those are things that you look at. The second is about in mid caps, it's very important to look at the strategic outlook. Okay, because you are trying to identify a company or business that has a potential to transform. Okay, so in fact, set the bar like that, saying that I will not invest in companies who are looking stable and okay, so they are like a large cap. I should start looking for companies which actually can become from a small cap to large cap, can become discovered by institutions, etc. And so it should have a minimum sort of size and scale, and then slowly the momentum is there and the vision is there from the promoters to be able to sort of take it to the next level. The third is looking at maybe strategic analysis and channel checks. Now on strategic study, there can be various ways to look at it, and let me give you maybe an example or two. Dixon itself, which I was covered in a past webinar by my team, Prabhat and Vijay. Okay, is into the outsourced of electronics manufacturing. So they make mobile phones and other electronic items for some of the largest global companies. And so when we looked at some bit of stuff around China, and the US trade wars, okay, we sort of felt that there will be a bit of a shift for companies and MNCs to start looking at other countries to do their manufacturing, at least from a risk management standpoint. Okay, if they continue to use China for a longer period of time, from a risk management standpoint, felt that they would end up looking at India and other countries. And we thought Dixon, already having some of very good companies in their bag as clients, was very well suited for an unlocking. And so I'm saying that is one example. The other could be where we look at it from a let's say broader industry perspective. Okay, and once we took a call which was around specialty chemicals, because again there was the reason for it is data. When we were looking at it, we realized that China is exporting less and less of specialty chemicals, and because of pollution control norms that became much stricter in China. Okay, there was a move that was happening away, and some of the Indian companies were very well placed. And if we went back and also studied some of that, when we went and did that and did a deep dive, went to the market, tried to understand a business, but they're slightly more complex ones, trying to understand what are the various things that they are exporting or manufacturing. We realized that many of them have very deep expertise and global expertise, and they were really ones which could transform. So we bought a few names in that space, okay, which sort of transformed over a period of time. Then the example that I gave also, like when we did the specialty chemicals, we tried and did a deep dive into the channel and people who are from the industry, etc. The other thing that you need to look at is search for triggers that could transform the company. Okay, and I did some of it could be, okay, it's setting up a manufacturing facility. I spoke of the China and Dixon there. Okay, so there could be many triggers that could really transform the company and sector, and where it is not done well in the past also. It could be, for example, earlier pharma was not doing well. So how do you track some of those industries and say, okay, what is the inflection point? Because at some point, pharma will come back, because as a sector, it is definitely not going to go out of shape for the long term, because you have people who will continue to fall ill, and you will have medicines which are sort of required. It's a basic necessity. So the sector which sort of comes down is something also you sort of track for turning points in the industry. Okay. Now the screening is the other thing to start looking at, because how do you start finding new names? Okay. We use screening, for example. We use third-party reports, and what I used to do in my investing career is I would just buy some 4 different magazines. You had a lot of them: Capital Markets, the Wall Street Journal, and many that came up over that period of time. Okay, and just look at all they keep on throwing up a number of companies there, and from them I used to find out 3 or 4 or 1 or 2 which was of interest, and then start doing research on them. Okay, because you need a trigger to start looking at a company. And very important for mid caps again and small caps is that you should be able to do a deep dive, look at annual reports, financial modeling, look at various sectors, okay, and what is moving, what is not moving, and then look at how things move forward. And this is an example that I'm giving of how, if you discover a company right, how the move can be very large. Okay, of course Dixon has come in a bit of a correction, so it so that is something that one can look at it. Okay, but and possibly these are opportunities to buy. Okay, but if you look at a graph like this, it really moved very sharply, and there was a point after which it started moving. And what may be the trigger for some of that? Okay, the trigger is actually it got discovered by funds and foreign institutions and all. So a company like Dixon, which is a mid cap, okay, you'll find that today FIIs own 20% of this company. Okay, banks and mutual funds own almost like 10.92%. Okay, so there is a very good institutional holding and foreign investor holding in the company, which is what my point. And that's what, when those type of larger investors come and put in lots more money, you find some of these companies really take off. So finally, I want to keep it short so that we also have Q&As, okay, for about 15 minutes. So what are the takeaways that I would like to bring across to you? Okay, markets move in cycles between mid and small caps, mid small caps and large caps. So we need to be able to look at these cycles, and if one is able to get these cycles right, it will be very rewarding, right? Because we've seen in a year, say, small cap index even delivered some 60%. The mid cap index delivered 48%. So even if you get part of it, even if don't expect to get all of it, because if you did that, you would have fallen very sharply the next year. Okay, so leave some of it at the end. Okay, maybe in a phased manner, book profits or take some of the profits away, so that as things get better, you can only do better. Of course, keep in mind that an early exit, okay, can be very damaging for you, because if you went back and saw Dixon, for example, right? If somebody said, okay, from 400 it went up to 800 rupees, okay, that's wonderful, let me exit. Okay, you missed out Dixon going to 4,000 rupees. Okay, so you missed that 10x. Okay, so you shouldn't give in mid caps and small caps. You should look for multi-bagger returns, not just as 15, 20, 25%. And if you have some of these type of companies in your bag, okay, that will really do well for you and take up your returns. Okay, so however, the warning, okay, mid caps are higher risk, higher returns, and when the cycle turns, the falls can be very large. Okay, I gave you the example that in 2018 and 19, you would have found that many of them fell between 40 to 60%. Okay, and they can be really damaging and really change your portfolio, and that is what sort of brings them back to returns which are similar to large caps over a longer period of time. Okay, we can argue that we can expect continued buoyancy in mid caps, and I've given you the charts and the basis for that for possibly a year or two. Okay, and follow disciplined investing process for better returns and consistency. Okay, again, it's a basic which I like to always reinforce basics in every webinar. And the point is, while you look at investing in mid caps, look for companies that can transform. So you look for stability and for growth, consistent returns, etc. In your large cap companies. But when you're looking at mid and small cap, set the bar high, okay, and start looking for companies that can become multi-baggers and really do well. Now, you need to keep in mind that even from my own experience, while I focused on multi-baggers, not all of them ended up being multi-baggers. Okay, but you need at least 30 to 40% of your portfolio to become multi-baggers. And because I would also hold some of the larger cap companies, and I know that something like that cannot go up 10 times like a Dixon in the example that we had. Okay, so we may not be able to do that. Plus, in Dixon, we ourselves would not have made 10 times, because it's impossible to get into a company right at the start. Okay, so but even if you made that 200%, 300% in a short period of time, that's something that can really do well for your portfolio. And we continue to hold the company, so hopefully that will only increase, and maybe that will become 2x, 3x, 5x. So that's something which one can take advantage of. And while investing in mid caps, the focus should be basically to identify emerging leaders, and that should be the whole focus around it. And if you come back and if you look at for example our super value, which did well, there are many names there which can transform or continue to transform. When people say, how did it deliver almost like a 21% in 1 month? Okay, so this is something that we sort of keep in mind, that we need to look at it that how do we look for undiscovered names, and if you are able to get it right, then you yourself may see some very strong returns in the portfolio. So I will stop here and look for your queries. Okay, you can feel free to maybe post it on the chat. Okay, and I would be happy to answer. Okay, so Kala said, good to hear you after 5 years, Mr. Anil. Okay, thank you. I'm happy to be talking after 5 years. Yeah. Yeah, so here the questions come, sorry. Yeah. What about the strategy of simple investing in passive funds, say mid-cap funds? Okay. See, different people have sort of different ways of investing, and it's important you follow what you are sort of comfortable with. Okay, for example, some people really like to look at stocks and companies and track them and stuff. So then yes, be invest. They can be investing in those stocks and they'll probably do well for themselves. Okay, simple investing in passive funds is not a bad way of investing. Okay, let me, however, say that the experience in India is when you're talking about passive, you're talking more like index funds, etc. You find that actively managed strategies do better than passively managed strategies in the long run. Okay, in India. Okay, in countries like the US, it's very difficult to beat the index. So we are in a period still when one is able to sort of beat the index in funds. Now there could be periods where in the last maybe let's say 18 and 19, there was periods when concentration really helped, and it was very difficult to beat the index for anybody. But that again is sort of changing. And there could be periods when it's better to invest in passive funds. So what I would always suggest is do a combination. Okay, do a combination of passive funds and actively managed strategies. I think that for some of few years, one would expect active strategies to continue to do better than passive strategies. Okay, so the second question that came is how to play the sectoral story within mid caps. Okay, the sectors, like I said again, for people who invest in stocks and sectors, okay, it makes sense to do that. But for most retail investors, I always suggest just do diversified stuff. Okay, where you have the expertise of looking at sectoral turning points, stock turning points, and understanding them, then you look at it. So a sectoral story is, it's always good to look at a sectoral story based on what you think is going to happen in the future. Okay, so the example that I give you, we expected specialty chemicals to do well in the future because of a certain reason, right? So something like the electronics manufacturing and overall manufacturing in India also, with a little bit of a push, with some bit of movement away from, let's say, China, and this is now becoming larger. What further changed is, the tiff between China and India on the border, I think, was used very effectively by the government, and sort of cutting down imports. So I think manufacturing in India will do very well. So you could start looking at those themes and build on it, and so I think the best is you have to have a view of the sector first, and once you have a view of the sector, start looking for companies within the sector. So this is called a top down, where you look at sectors and then look at stocks. Some people like only a bottoms up, saying that, okay, I like the company, I don't care about which sector. But I think a combination of both is always useful in my view. So the next question from Surbi, is this the right time to enter the market as the market is so high. Okay. See, I look at various data, including how people invest, and one of the reasons why I think that it's still not a bad time to continue to invest in markets is actually the retail investors pulling out money from the markets. Okay, and if you see there is reasonable outflows from the domestic institutions, which basically means that people are selling their mutual funds because they think market is high, and market typically is a longer term cycle, and post that you'll probably find one more move up for a period. So I think for about a 2-year period or so, I think market continues to be a good place to invest. At the same time, markets can be volatile. Okay, so for an investor who doesn't have too much of knowledge of markets, I think the systematic investments are a good option to enter. Of course, on market falls, like right now, market did fall. It fell. It crossed. Let's say the Nifty crossed above 15,000 and then fell back down. So those points are again points which you can sort of enter and take advantage of. So a combination of I think investing on market falls and investing systematically is a good strategy to continue to adopt at this point of time. Okay, is it possible to, from Raj, is it possible to identify index funds so that we can move with the index? Is this recommended? The good part is, I think there are many more index funds and ETFs which have sort of come up. Okay, now those also can sort of be used. The index funds are not a problem to invest irrespective of liquidity, but if you are touching ETFs, which are even lower cost than index funds, it's ideal for you to look at how liquid is that particular one, okay, the ETF. So because when you want to sell, you should be able to sell without too much of a price impact. So yeah. Satya, sorry, said, I joined late. Can you share the recording? Yes, we will definitely share the recording. Okay, show me the PPT. We will share the thing itself. Okay, so don't worry. Yeah, Piyush also answered that we share the link. Okay, Nidisha. Okay. I want to know when to sell a mid-cap. Suppose I'm getting a return of 50% suddenly without any solid reason on a mid-cap stock. Should that be a trigger to sell, like it happened for many stocks in this sudden surge in the stock market? Okay, so I think that was a question for somebody else. Okay, which I posted. Yeah, so we need to keep in mind that it's in mid and small cap, like I said, you need to start looking for multi-baggers. Okay, a 50% return can be low actually, if you ask me, with mid and small caps. So you should look to ride the rally. What you can do, of course, is when you see a very, very large spike, okay, maybe you can take out a little bit of your return, and if there's a correction, put it back. If there's no correction, then you should be willing to live through it. Okay, but I would really wait for much larger return. If you are an active investor and can look at timings a little bit, like on our funds, we do it a little bit, and even on stocks like Dixon, we would have here and there at different points of time, maybe book some profits, okay, and take an advantage of market volatility. But my point is, if you are an investor who is not able to catch the smaller rallies, then you should probably leave it. When you think that markets, the mid cap and small caps are a little overvalued, okay, then you can start making the changes and start exiting your stocks. And like I said, start looking at much higher returns, and I'm sure you can also make multi-baggers. Are mid caps dealing with cryptocurrency good to invest? Okay, so yeah, I think that I always like to avoid investments into areas which I am a little wary of or I don't understand. So I think on cryptos, I would say that I don't have the expertise. Okay, so for somebody who can go through it a little bit of detail, but I don't know if you have listed stocks which sort of take allow you to invest in cryptos. Okay, but I think that I would stay away from giving too much of a thing because I'm not aware of the crypto stock either. Then we have Mukund. If one looks back, hardly few midcaps beat Nifty Midcap 150. Isn't it too risky and higher volatility to indulge in midcaps? Yes. In the data that I showed, midcaps were slightly higher than large caps. And if you look at longer periods, in some periods it did better, some periods it did worse. Okay, but they were very, very similar returns. So for a retail investor, I think you can choose to do that. But if you're a professional or you are looking to deliver a little out of the market, the cycles that I showed you, right? There are periods when mid caps do better, there are periods when large cap do better. So if you are able to follow a bit of a contrarian type of approach, you'll probably deliver much better than the index itself. And so in those periods, you may find, in I think 2018 or so, we found that 48% return in the mid cap index and 60% in the small cap index. So you may see outsized returns, okay, and but there is that outsized falls as well. So again, based on your risk appetite, if you are able to manage it yourself and understand market cycles, then you can play around. But otherwise, you can just use maybe a multi-cap fund or something like that, which may sort of do better. Raj has asked that you gave an example of Dixon. How should one identify stocks of the kind of Dixon? So Raj, I try to capture that as the core thing. Right from screening to actually searching for ideas from third parties. Okay, one looks at it, but you have to come back and look for triggers. Okay, so if you are able to foresee some of these triggers which will transform, okay, either the sector or the stock, okay, then that is easier to do. For the others, it's very, very difficult. Okay, so now again, for how can you identify some of the others as well, which you may not identify from a trigger? The screening process is like what I also spoke about, which basically means that how do I look for companies which suddenly spike in profitability growth, okay? And if it's a mid-cap stock, for example, then I go and investigate that. So there could be triggers on certain parameters of maybe profit growth, it may be revenue growth, suddenly something which is changing, right, for the better. Okay, I look for some of those and things. So the other message from Kavita. Kavita Nair, sir, can you please explain, is it better to invest in physical gold or gold ETFs? What are the drawbacks of different avenues? Okay, so typically I prefer gold ETFs, especially if you're investing. If you're buying a jewelry, I think physical gold is the best. Okay, but if you're investing, I think gold ETFs are the better way to do it for a few reasons. One is you can enter and exit easily at low cost. If you do that in physical gold, you have charges that hit you every time you buy and sell. Okay, so that sort of makes it inefficient. This one also is much more easier. You don't bother about safekeeping. What if somebody steals it, etc.? Nothing. It's just in your account. You buy it, you sell it like a stock on the ETF. Okay, so that's, I think, the better, both from a cost standpoint and your ability to move in and out. I think makes it much easier. Jerry Santiago asked a question. Besides specialist chemicals, what are the other industries you are focusing for midterm or long-term investing? Okay, so Yeah, so we have, I think the whole manufacturing side is, sort of interest to us. There are some ventures which are sort of based on technology, which are again of interest. Okay, on the financial services side, again, there are some differentiated opportunities that we are looking at. So I think uh, we believe that some of the earlier FMCG and stable companies which deliver good return may continue to deliver, but maybe at a smaller percentage. But some of these sectors which were sort of badly beaten down, okay, should come back. In fact, even sectors like real estate, etc., I think will come back, as interest rates have fallen very sharply. So, what are the sectors which benefit from lower interest rates? Okay, is the other thing that I think will benefit considering the steep fall in interest rates. Uh, from Raman Garg, how much fundamental parameters like P ratio matters for shortlisting stock? Okay, so P ratio is maybe more an exclusion one, but when we look at fundamental factors, we look at ones which are closer to the company, like what is the profit growth, what is the operating profit margin, okay, so we look at what is the debt equity ratio. So there are a lot more ratios which are more linked to the company itself, and those are basically the fundamental parameters that we look at. Valuation parameters like P ratios are the ones which will then, will decide to come in and go out and maybe time the entry or exit. Okay. What services are offered by Right Horizons is the question by Mohammed. Yeah, so we do an end-to-end across the wealth management, and we also have our TMS. I think somebody can reach out to you, and share the details. Krala, so what should be the mid long-term strategy on stocks which were once flying, now died down? Okay, Yes Bank, Idea Vodafone, etc. They were good companies once. So the issue is once something is large and damaging in a large way, we typically, don't like to sort of get into it. There's some investors who are, bargain hunters, and they try to look at, okay, Yes Bank has fallen 50%. It's a great bank. Let me come and buy. Okay. Then one finds that there are further news that keeps on coming in. It continues to go down. It may come down to even 80%, right? So and we've seen that those type of falls in Yes and Idea, Vodafone, etc. Okay, so what we, and it's very difficult to predict what is the exact inflection point. Okay, so what our view is that we rather look at some things which are more predictable. Okay, so even if it means that there is a potential for higher return, and we are, it's very, very difficult to identify what is the exact turning point. I'd rather look for other companies, which have basically positive triggers and go after them. Okay, so that's my point, and especially I may here and there look to do it on my personal basis, but when I'm managing clients' money, okay, definitely I would always not like to, as I would call it, gamble, right? So I would like to take informed bets, but not gamble. Okay, so but where it's not, let's say, a corporate governance or something really large. If it's a natural cycle, right? I'll give you an example of, let's say, the auto cycle, which really came down. Okay, it did very well for an extended period of time, but then all the Marutis of this world and the best of blue chips, Aisha Motors, etc., fell very, very sharply, right? And those are ones which we are happy to relook on a market cycle. Even the pharma companies as an example. So I want to differentiate between those. Okay, and but where something is damaged and damaged badly, okay, we have to have good fundamental reason to believe that nothing has impacted the company fundamentally. Okay, and then we would do, but we would be very cautious on such investments. Gautam has asked a question as to how do you determine the undervalued stocks, any metrics to go after? Okay, so there are various valuation metrics as they are called. You have things right from price earnings ratio, how much is your price to your profits. Basically, you have the price by book ratio. You have many of them, and typically what you will do, you will then go back and compare it with other companies in the same sector. Okay, and then you would start looking for it, and also you would also look at valuations as compared to the past, which means that okay, in the past pharma companies were trading at say a 50 P, now they're at 25. Now that 25 may be higher than what it is for some other sector. Okay, but we have to also sort of rebase it with the sector as well. Okay. uh, so coming down, Raj has asked, due to the pandemic, the real estate sector is being promoted as an investment in commercial areas. Is it worth considering? Are there specific factors to be looked into? There is noise. Okay, so Raj, actually, this is more on stocks and not on real estate. Okay, but what I believe is maybe commercial real estate is a little more impacted by COVID. I think residential will pick up a little strongly, due to lower interest rates. Okay, so if you are investing in commercial areas, just be a little careful about the potential of impact, due to COVID type of factors. Another question from him saying that there's a lot of noise around EV stocks. Okay, since the focus on alternate energy. Actually, I have not tracked EV stocks, so maybe I'll have to give it a pass. Okay, but yeah, so if something is good for the longer run, okay, that is definitely thing to consider. Okay, Surbhi, thanks for so much insight into midcaps. Welcome, Surbhi. Happy to share. Okay, yeah. So I think if I will start cutting down on the questions. Okay, if anybody has any questions, okay, because we are also past our time. Thank you for participating and being part of this webinar, and look forward to doing more of these sessions and interacting with all of you. Okay, thanks for your time, and on a Saturday to step back and listen. I just hope that you were able to take some learnings from this and help you achieve your goals. Thank you.